Welcome to the new Barbarians Podcast. I'm Bill Mann.
And I'm Mark Connors, and we're here to deliver insights on how current macro trends and market events have changed the value proposition on traditional assets like equities and bonds, the things Bill and I grew up trading, investing, and researching over the last 25, 30 years. Instead, we think it's digital assets that are setting the new financial and investment frontier for investors like you going forward.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So hit the subscribe button on your favorite podcast platform, and let's cut through the noise together.
Hello, everyone. Welcome to the new Barbarians Podcast. This is episode number 8. Today is Valentine's Day, February 14th, 2025. And why don't you take it away, Mark?
All right. Thanks for that, Bill. And before I jump into my macro review of the week, which will definitely set up nicely for a conversation for our guest today, Kevin Jiang, who is a former colleague, respected fellow digital asset compatriot, and a font of knowledge given his TradFi and digital background. So, Kevin, if I got it right, you, I do have it right because I know you are the CIO of Virgo Digital Asset Management.
Yeah.
Based in Vancouver.
Yeah, that's correct.
All right. Well, why don't you just give a little bit of intro? I know why I had you come to our guest show here. Why don't you tell everybody a little bit about you so that they appreciate your position as a subject matter expert in digital assets, especially all things strategies and trading.
Thank you, Mark. Thank you for the intro, and great to be on the show. So right now I'm the Chief Investment Officer at Virgo Digital Asset Management. We're a Canadian investment manager, and we specialize in alpha generation strategies. With a focus in digital assets. Previously, I was a head of trading and portfolio manager at ThreadQ, who's an ETF issuer in Canada. We brought the first spot Bitcoin and Ether ETFs to Canada back in 2021, so a couple years ahead of BlackRock. And previously to that, I was a trader on the fixed income desk at Citic Securities. So great to be here. Thank you, guys.
Got it. And can you talk a little bit about Citic and what you did there before joining? And also for backdrop, Kevin and I worked at 3IQ together. And when you go through the crypto winter that started when I joined in March of 22, when the Fed unleashed that interest rate, the assault on interest rates by raising them at the fastest rate in the history. And then we had the debt ceiling issue, and then we had bank failures. You learn a lot about a person and how they operate, and Kevin was the best to work with. I want to mention that we did work together. So about Citic, were you trading digital there, or it was more traditional assets, right?
Yeah, like back then, I was trading fixed income markets. So we were focused on interest rates, fiscal and monetary policies, and stuff. Yeah, so a lot of like macroeconomics, and it's funny how, Bitcoin has become a global macro risk asset. So now it's correlated to rates, it's correlated to US dollar strength, it's correlated to to a lot of like traditional macro things, just on different levels. So it's kind of great to kind of pick up that old toolbox, dust it off, and then it's very helpful. It's very helpful.
Yep. Cool. Well, let's rip up. We had 5 days of a lot of events, and when we have your own podcast, we want to make sure that everyone listens and that there's a reason to listen. But I'm not being hyperbolic when I say that. I think there was a turning point that we'll look back on this week as a tracer bullet for a shift in the markets, and a harbinger of what's to come. I don't know if we're able to, Chris, roll up some slides that You were kind enough to help prepare with me. So on the week, it looks like, kind of a risk-on environment, but that definitely was not the case. We had a blowout jobs number that disrupted the market last Friday, a week ago. Again, this Valentine's Day. We're going to drop this on Monday, but we're speaking to you on Friday. So over the last week, blowout jobs number, we'll talk about that, about how we think that's a charade. I do. Chris gave me some extra data that supports that just ahead of this call. And then Wednesday, we had CPI that, just as Fed Chairman Powell is speaking about how his 2% PCE target, we're not there yet, but we'll get there. As he's speaking to Congress, CPI gets dropped higher than expected. Markets drop, 1.5%. But they rebounded by the end of the day because on the back end, you had the potential peace dividend from Trump solving the Ukraine war crisis. Zelensky is going to potentially speak to Putin. I mean, there's a lot going on. Oil sank on that as well because obviously there won't be a backlog anymore. So the 5-day move looks fine. A lot of volatility in the middle there. Month to date kind of dictates a little bit about where we are. We've been selling off in digital assets, or a little bit of a mixed bag. That's why Bitcoin's down in the month. But if we look at the two persistent winners, it's that European equity index, shocking, the $4.5 trillion stocks 50, which I think has averaged 5 to 6% over the last 5, 10, 20 years. It is up 12.6% year to date. Gold's up. Bitcoin, obviously, the third largest gainer across major asset classes, which to what, Kevin might drop some knowledge on that as well. But we're gonna rip through some other headlines and then drop and have some commentary on the events that you can see in our Substack and any other technical aspects that we talk about, the tools we use. You can go to Harmonic Insights website as well to look at that. But on the next slide, we look at gold. So this is a 5-year look price chart. It kind of went sideways, but it jumped in January. And we think that's related to the expectant QE that's coming as QT drops off. So we'll talk about that later. Let's go to the next chart when we look at the 55-year or the 50-year price chart. This is a logarithmic scale. So it's not in linear fashion. It's to show you the different movements. We had the 1970 move when gold went from $35 to over 800 by 1981, 1980. And then you had the second move just before the 08 crisis, which gold went from, I think, $250 to over $1,600 by $1,800 by 2012. And we believe that this is the next movement, that gold's just starting to move. And that as it pierces 3,000 and gets more attention and printing comes, we think gold could, here at Mr. Mentions at least, we think gold is on for another percent move, 100% move plus over the next several years. But let's roll down about what some of these drivers are. Why is this happening? On the next slide, what you're going to see here is receipts and outlays. And let's just look at the outlays, the expenses: Social Security, national defense, and then net interest. There's not a lot you can cut in order to try to get deficit in. And net interest has gone from the 5th largest to the 3rd largest. And we won't even get into the fact that that's understating it, because some of that income that they're getting from, say, student loans will be written off. So gross interest is a lot higher. And the next chart really shows you what I think the fear is. It's why Scott Bessent is just saying, I'm going to get rates down lower. I'm going to get the deficit lower, because interest expense has skyrocketed as rates have gone up and debt has gone up. The interest expense here is on a gross basis, almost 1.2 trillion, and it's only going to increase by another couple $100 billion this year as we roll into higher coupon debt and we add more debt at a 4.5% level. To give you an idea, I think it's something on the order of 20 trillion or 15, 18 trillion of notes, anywhere from beyond 1 year to 20-year paper, is at about a 2.6% coupon. We're going to roll off $2 trillion into a 4.5% coupon this year on those notes. And we're adding another something in the order of 2.5 trillion. In other words, this is untenable. So that leaves me with three events. Chair Powell in Humphrey Hawkins was probably the most contrite I've ever seen him or any governor in front of this biannual meeting. When asked about comments made by his chief counsel and by him to previous Congress people and to Senator Lummis, he said that he was going to look back and check on the degree of debanking that went on. Something that he said in November of 24, just months ago before the election, that it was overstated and a non-event. He totally reversed course and said, yes, it's concerning. There have been a lot of allegations. We're looking at this, and I'll get back to you. And this is talking about choke 0.20, Kevin, something that you and I saw front and center when Silvergate and others had bank runs that we think were forced because of policies the Fed, I think was forced because of policies the Fed made. These are damning statements. They were not negated by Chair Powell. And I think, again, we're going to look back on that testimony on that day and say that that was a turning point where the powers of the Fed were diminished greatly and the doors were opening for digital assets greatly, still not priced in. And then the last one I want to talk about was Bank of England on two fronts. First, you had, I think it's Deputy Executive Committee member Ramsden speaking about the gold in the Bank of England Reserve, which is being drawn upon. They have an 8-week backlog because the price of U.S. gold is much greater than European gold because of tariffs, and people are trying to buy the gold at discount. They can't deliver it. What was that? He said something about a truck being in the way when he went, a lorry being in the way of his door when he tried to, like, he made silly comments. Again, not a high moment for the Bank of England. And then lastly, again, the Bank of England, they are backing up the truck on supporting all financial firms by allowing a program to backstop and offer loans against any gilts held by any financial institution over $2 billion. So that's basically a liability that they have, which I think will be expressed by more printing of gilts, dollars, like we're doing in the U.S. So that's why the debt load won't go away. That's why debasement will continue, is because we have a fragile system that the central banks are recognizing. So that's way over my time limit. Surprised you guys didn't bring the hook. But I did want to belabor the point, as I did, that the markets are reacting, gold, low PE European stocks. Central bank governors are changing their tune, some being contrite like Powell and like Ramsden, just having no answer for the price of gold and not recognizing that there's a run on gold and using silly answers. So that's the backdrop that we have now. I don't know if anyone here has any other insights on the week that they saw talking to clients or things that speaks to any of the kind of dynamics I spoke about, or are my observations not really kind of consensus now?
I think those are pretty good, Mark, but I do have what's perhaps a innocent question. What are the proposals to bring down interest expense or to manage the debt load? And I suppose they can be different in different countries, but like Besant, for example, how do you think he's going to try and tackle that?
He has a 333 program, which is kind of borrowing from, I think it was Kuroda, maybe in 2014. He's a fan of the Bank of Japan, which again is a cautionary tale of high debt, low birth rates, and low growth. So maybe he's trying to get ahead of the curve and adopt that model. He would like to see a 3% deficit, which, again, I don't know how you would achieve that. That's one thing. He'd like to see 3% growth, which we're under right now. And I believe the third 3%, it was deficit, growth, and it wasn't interest rate. I forgot what the third three of his arrows were, but he would like to do it by fiscal austerity, which, based on that first chart, Bill, I don't know how anyone attains it. And to answer your question, the market doesn't believe it either. That's why the 10-year blew up 100 basis points higher when the Fed started lowering rates. They're like, you guys are crazy. You have a deficit issue. We have probably more. You don't have the ability. There's no reason to cut rates. So I think the market is in not your camp, but says there is no way that we can bring interest rates down except by asset purchases, which is not being contemplated, but I think will happen this year as you just basically have more volatility in the long end. We're going to be issuing another $3 trillion. And if you look at purchases, I think the front end of our curve, Bill, is like $7 trillion of our $36 trillion in debt is in T-bills. That is much more than what is prudent. We should be distributing out along the curve. We didn't. We went to the cheap front end when rates were low because no one wants to have long-term debt. So that's it. Just watch the 10-year, watch the volatility, and watch the MOVE index. And I think that'll tell you whether or not the market believes we can lower rates and handle the deficit. I don't think it's possible.
And, maybe a related question. And my first one, I think I was somewhat expressing my own view that that's not going to happen. But we also saw inflation print higher this week, but Bitcoin down. And we've touched on this in the past, but that might actually be a good one to kick off a discussion about the sort of opposing drivers of risk assets versus inflation hedges. And sometimes you see a dip and then a subsequent bounce, and it's hard to tell exactly what's driving what, but we did see that this week, right?
We did, and I'll touch on that. I'm going to kick it over to Kevin, who's been trading it actively more than I am. When you see the prints, I think Bitcoin has switched from a pure risk asset, which means it'll trade like an equity. In times of stress, it'll drop, and then in times of high liquidity and market FOMO, it'll spike up with, say, the NASDAQ. It's changed a little bit. And as it relates to day-to-day movements, you still have the leveraged stock jockeys that now switch into digital assets, trading 5, 10, 20 levered times Bitcoin, Ethereum books. So they're the first to move. So if there's a shock one way or the other, they're forced into either a margin call or they deleverage so they don't have a margin call. So I think that's a little bit of noise. That's my opinion.
Hey guys, if you got anything out of that last segment, please share with a friend, comment, subscribe. It really helps us grow the channel. Thanks.
But this is why we brought Kevin on. So Kevin, I don't know what you want sort of approach answer Bill's question, and then maybe through the lens of what you guys are doing there to give good risk-adjusted returns to clients.
Sure. Yeah. So actually, you mentioned the U.S. debt level interest payments, and that's actually what I think could be potentially one of the biggest drivers of this year's risk assets. That is the lowering of long-term U.S. interest rates, right? Like you said, right? I think the U.S. Treasury debt structure is very front-loaded we had almost $10 trillion in like the shorter end of the curve, which are up for renewal, right? I think a substantial, like 20 to 30% of the entire outstanding debt is maturing this year, so they have to be renewed, right? So think about it. Like if you have a house mortgage that is up for renewal this year, right? You could either borrow at the current rate, right, and then lock in at 30-year fixed rate, had the current interest rate level 5-6%, or you could take a shorter deal and wait for the interest rate to come down, right? Any smart person would say, okay, I'm going to take the second route. And then we have perhaps one of the smartest traders ever that's manning the Treasury Department right now. So what he's got to be thinking is that, okay, my objective is to minimize my long-term borrowing cost. And for the US, that's somewhere between 10 to 30 years. I could either borrow and refinance at 4.2%, which is the rate right now. That rate will gradually come down because the ceiling right now is 4.5. That's a Fed rate is 4.5. You can't, short-term rates can't go much higher than 4.5, right? So one scenario that they could play is they're gonna issue shorter treasuries for this year and maybe next, wait for long-term interest rates to come down. And because they're not issuing long-term treasuries, right? There's going to be a supply shock on the long end. And when the narratives of the tariffs driving inflation, when that comes down, right? The long end of the curve will come down, right? And when it's sufficiently low, the Treasury will then start issuing more debt on the long end. And because in the past a year ago, short-term interest rate was at 5%, and we were at 5% interest rate for 2 years, 22 and 23. So all those 5% treasuries are going to mature, and they're going to be replaced by 3%, 3.5% longer-term treasuries. So that's right there. That's like a 40% reduction in interest payments.
So back to Bill's point, how is Bessent going to bring the curve down? You think it is more that it's artificially high because of tariff saber rattling?
Well, market trades expectation, right? And like for a very long time, the interest rate curve was inverted. We had a lower long-term rate than the short-term rate, and then that changed like last year around Q3, right? That narrative changed because the shorter end came down, not because the longer end went up, but the shorter end came down because the Fed started lowering interest rates. So when you have that scenario, right, and then we know the Fed is more likely to cut interest rates once or twice than hiking it again this year or in the next 2 years, right? So and because you're the Treasury, you actually control what maturities you offer, you put out for auction, and what maturities that you don't or do less, right?
Yep.
So they could manufacturing a little supply shock, right, on the longer end side of things, right? And then when the inflation talk dies down, because inflation is only at 3%. I mean, it doesn't justify a 4.5% long-term rate.
As far as they measure inflation, they agree that real rates, they have room to go lower.
Yeah,
for sure.
Yeah, and I think there's a strong narrative, a strong mandate, a political mandate to bring down the federal deficit, and a big chunk of that was interest payments.
Yep.
This is something that they will do, right?
And so that means weakening. That'll help weaken the dollar, which will increase liquidity. Back to your point, which is good for risk assets, which certainly Bitcoin has a flavor of that, as do majority of digital assets. So do you think that flies in the face of what they're saying as well, Bessent, about Trump wanting a strong dollar? That's just lip service. I mean, unless you think that they think it's a strong dollar is a relative term.
I think strong but not too strong makes sense.
Mm-hmm.
Like there's a sweet spot, definitely a sweet spot, and that's probably somewhere between for the dollar index, somewhere between 105 and 110 seems like the sweet spot. Like all we have to do is, plot like a correlation curve, right? Like correlation chart to see like what other periods, like what other periods that SPY perform the best, right? Is it when like the dollar index is super strong, or is it within the range, or is it super low, right?
Yeah.
I think there's a sweet spot. Yeah, I think like having tariffs, right, drive up the demand for dollar, right? Like it strengthens the dollar, but then, having lower interest rates kind of help offset that, so that we, hopefully we maintain to a somewhat of a sweet spot, right?
Mm-hmm. Well, as you know, Bill and I and Chris are mucking around in digital assets, have our theses about it, our opinions, and I'd love to get your thoughts about what your product is, because we just went through 15, 20 minutes of global macro gobbledygook, and it's, we don't know, we have an opinion, but how do you position your book to minimize risk for clients? Because obviously the four of us think there's opportunity in digital assets, and obviously the majority of people don't agree with us, because the asset class is only $3 trillion, Bitcoin being 60% of it. So I'd love to go through, as we're talking about this, some of your strategies and how you think they perform in a high dollar or low dollar. Use that kind of idea.
Yeah. So thank you for asking that question. It's one of the first questions that we're thinking about when we first got started, and one of our products we actually take short-term U.S. Treasuries. So, and that's why I spend so much time like studying interest rates. We take short-term U.S. interest Treasuries, and we use the interest payment from the Treasuries, and we invest that into a high return potential option strategy. So at worst, right, you lose your interest income for the year, but your principles is still more or less intact, right? In fact, we can actually design the strategy so that it's principal protected for our clients.
Magic words right there.
And this strategy actually returned 39% last year, because we were able to use capture some of the very aggressive moves in Bitcoin using options. And like you could in a bull market, right? You could risk like 2%, have like 20x leverage. If you catch the wave at the right time, you're golden. So that's one of the things that we've been working on.
Got it. And do you think the pushback I've seen from people is they either don't want to understand Bitcoin, they don't have the mandate to do it, or they still think it's too volatile? What's been your client feedback on strategies? I know you've had some success for sure, but there's still such a big swath of people that aren't, I feel, open to it.
Mm-hmm. Yeah. So one approach that we kind of take when we are communicating with clients is that like there are two types of risks. One is volatility, right? And that you measure that by like standard deviation and all that good stuff. And the other is the permanent destruction of capital, right? So when you're investing in a stock, like a junior issuer stock, you're taking a substantial amount of that permanent destruction of capital risk, right? When you're investing in the meme coin, like GameStop, you're taking on that risk, right? But then if you're investing in something of quality, right? It could be Tesla stock, it could be Apple, it could be Bitcoin. You're really not taking as much of that permanent destruction of capital risk. You're just taking volatility risk, and that's actually the better type of risk to take, right? If you had to choose between the two, and the return more than justifies the volatility risk that you take. And also, if we just measure based on realized volatility, I think Bitcoin will fall middle of the pack if you put it against the Mag 7s. Right? I think it's around the same level as Meta Facebook, but it's less volatile than Tesla and Nvidia.
Yeah.
Right? More volatile than the other. So it's kind of middle of the pack. So if you can tolerate tech stocks, then yeah, Bitcoin. Yeah, you shouldn't feel out of place with Bitcoin in your portfolio.
Well, that's Bill. Have you looked at any digital assets through those kind of factor lenses like quality? Is there any rubric to kind of make that direct translation of some of the work you've been working on with Chris?
So that is in fact the project we're working on. We're trying to develop.
I didn't know that, folks. Just to let you know, that was not a slam alley-oop for Bill.
That is actually we're trying to build a list of factors in crypto that are similar in nature to the ones in equities. And, I think last week with Connor, I think that's a lot of what he's doing with his, long only quantitative methodology. But, personally, the way I think about it is, the meme coins and things like that with names like fart coin, typically, I think do expose you to that permanent loss of capital. And then if it's a technology that we understand and believe has a use in the future, it's going to be more akin to a company or a technology company. So in terms of, value or quality, those are sort of the markers that we look at. And then, I was just being facetious about the meme coins. Like, I think we're all just avoiding that period. But especially in the value / quality dimensions, I think that, there is enough data out there with on-chain analytics to, express opinions about one blockchain's relative value against another, based on adoption and things like that we can then forecast into the future.
Cool. Yep. Thanks for that. So Kevin, going back to your strategy on that, do you trade other assets besides Bitcoin, or is Bitcoin such a rich environment that you sort of stick with that from a liquidity standpoint?
Yeah, we were thinking about expanding our strategy to cover some of the other assets. So with options, like options is priced based on implied volatility in the market, right? In the option market, and you can actually look at like one metric that we kind of look at is, look at this a particular asset's potential return, right? You can measure from like its highs and lows within a certain look back window, right? So you can say, hey, what if if I were to trade the swing on this stock, like how much does it move, right? Is it like a 20% mover? Is it a 50% mover? Or is that something greater, right? And then we look at the implied volatility and kind of translate that number, do a little math, translate that number into, how much am I willing to pay to bet on that, right? If I can bet, 1% on a 20% mover, hey, that's great. If I had to bet 5% to get that exposure, right? Then, I may not we may not want that position, right? You may not be the best value for my dollar. So yeah.
So Kevin, that what you just said there, that's what Michael Saylor has so deftly wrapped up and sold to Wall Street by saying, he's a lower realized now, but I'm an 80, 100 realized stock. I'll sell you a convert with 50 implied.
Yeah.
So he's selling cheap options out that Wall Street's gobbling up. So when you talk about volatility, I don't know if you have an opinion about how his strategy and monetizing his volatility relates to your strategies. Is it similar that you're both trying to play cheap versus rich vol in different structures?
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
his strategy is on a next level. But yeah, he's a genius on what he has accomplished, right? The it's amazing to take a firm into the Nasdaq 100 index just by buying one asset and issuing debt. It's genius. It's like they call it the chattest move in the history of capitalism. He's beat the game.
Give our audience a little bit of a background, because
Yeah.
Bill and I, when we speak to investors, and Chris, I don't know if you've seen this as well, some of them don't know who MicroStrategy is. Because, for those not in TradFi or traditional finance, we are so balkanized. We have such a narrow domain expertise, and we're rewarded for that we don't even know what our neighbors are doing in other departments. So give a little bit about MicroStrategy, just like a nutshell about, as you said, how did he become a Chad?
Yeah, so they invented this this infinite money glitch. So the stocks, they found their stock, they call themselves a Bitcoin Treasury company. So they have very little net income as an operating business, but they hold Bitcoin on their balance sheet. So let's say they one day they found themselves, let's say their stock was trading $100, and they have the equivalent of $50 of Bitcoin on the balance sheet. So they found themselves at a 100% premium, and they figured, hey, if I sold another one additional share of my stock, I get another $100 back, and I can buy $100 worth of Bitcoin, right? Now they have $200 in stock, but $150 in Bitcoin. I have brought my shareholders a 300% Bitcoin yield, right? And the stock market saw that. They're like, wow, this is genius. We're gonna buy more of your stock. So now their stock is trading at $300, with backed by $150 of Bitcoin per share.
Yeah.
So it became a flywheel, and then the price got higher. They were able to raise more cash, buy more Bitcoin. Yeah, it's it's insane, but it worked.
So going back to your strategy, so you have the principal protected notes, and can you, for the audience, can you give it an analog? I mean, that's a product that Wall Street is very familiar with. Is that fair?
Yeah. So in the traditional sense, a principal protected note is often a GIC, right, backed by a bank, connected with some sort of option structure on the underlying asset. It's often a call spread, because that's kind of how you get the best bang for your buck with options. Because if the market trades flat, right, you're just losing time value on the option segment. And because most of the time the option market is very, very efficient, so most of the time it's priced just right. Mm-hmm. So that you if you're right on the direction, you make a little bit on the option income. So the outcome is typically slightly better than the GIC. So in the context of past few years, that means like a high single digit or a low double digit return, right? And that's if you're really, really lucky.
Right.
And like what we kind of do different is that we trade shorter term options, and we have an active option strategy, right, overlaid on top, so that we're more tactical in terms of like market entry and market exit. So we try to play that to our advantage. And the fact that we can actually make multiple bets, because we don't have to gamble everything on one round, on one trade, right? Which is usually principal protected notes, they invest all the investment income in like one option structure right at the start. But like with the way we are allocating for our risks for each trade, we actually have the luxury to kind of bet multiple times. Last year we were able to capture some like market opportunities really, really well. We looked at our trading history. We had multiple like 5 baggers, like 6 baggers, 8 baggers in a very short time period.
And you've traded both markets, traditional and digital. This is a leading question, but I find the volatility of Bitcoin to be crazy different than anything else, positively skewed. Even though it's high like the Mag 7s, it has a different behavior than equities, where it tends to punch more to the upside than downside. Is that something that bears out in your strategy? Or if you were to do this with Tesla or another equity, would you have the same opportunity set and same returns?
Yeah, Bitcoin is very unique in terms that you have like a very, very positive skew. You can expect that, right? For something that has gone from like less than $1 to 100,000, you can expect that. But you also see similar things in like mega stocks, because they are all, like they all came from $5, $10 to $1,000, then stock split, and then $1,000 again, right? So you actually do find similar characteristics. Obviously, Bitcoin has this 4-year cycle. So one simple observation that you can make is that when it's during a bullish cycle, Bitcoin will have like 10 months out of the year in the green. It happens every year, right? Like 10 months in the green. That's an 80% chance, like of Bitcoin going up in a month, versus 20% chance, right, of it going down. And yeah, you just kind of figure out where we are in the cycle, and yeah, that's kind of one way to place your bet accordingly.
All right. Well, here's something, and I don't know if it might play into some of the work that Chris did in one of his reports, but that leads to the question of how are we now outside of cycles if we have potential Bitcoin reserves? Are we breaking the cycle? Are we in the super cycle, the Omega candle, as Samson Mow, I think, calls it? Or do you think we're still bound to the 4-year cycles for reasons owing to Bitcoin or to markets themselves?
Well, if the Bitcoin strategic reserve becomes a reality, right? In the proposal, I think U.S. is going to buy 200,000 Bitcoins per year.
Under the Lummis proposal, yeah.
Yeah. At the current pace, only 160,000 is mined per year. So right away, that is a 20% supply gap that cannot be met. So the U.S. government, if they are to buy on the open market, they'll have to pray it out of your hands with a very, very lucrative price, right? And then you have all those countries trying to front run the U.S. government, all those U.S. states that's trying to front run the federal government.
Yep.
And yeah, so there could be kind of not rent off the bank, but rent to the bank type of scenario. So you have like sovereign states FOMOing into this asset. I think just today, news came out that the Abu Dhabi sovereign fund bought $400 million worth of IBIT. So that's huge, right? That might have been the first.
Wow.
A sovereign wealth fund buying spot Bitcoin ETF.
That's permanent capital.
Yeah, that's permanent capital, right? So yeah, I think the narrative is still very, very strong. And if we get there...
or it could be just a way to pay Larry Fink his fees for doing work for Abu Dhabi. Who knows?
Yeah.
Seen stranger things.
Yeah. So if we do get there, I think it's going to bring the 4-year cycle to a brand new level. Because we have 20% supply gap now. What's going to happen in 3 years at the next halving?
Yeah.
We're going to have 100% supply gap, right? The annual production is going to be 80,000, and the United States government is going to buy 200,000 that year.
Yeah.
So,
and then it's just a question of whether or not the mining cycle of upgrade equipment can, the cost of, well, actually, that makes it easier, right? If we do have that supply shock or that demand shock, that would offset the pressure that miners feel on capital equipment upgrades, to the cost to mine a Bitcoin. So that could be a virtuous cycle, because I think that's an impact. But Chris, on the recent paper that you did, is there anything that came up as far as cycles? I know that yours was on Ethereum, not Bitcoin, but is there anything that in your work that you thought would inform on whether or not when the hell all season is going to come? You know, people waiting for bated breath.
Yeah.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
Yeah, well, first I want to ask Kevin, because I wrote a paper earlier this year on this. What do you think the main drivers traditionally have been for the 4-year cycle? Do you think it's mainly the supply shock that comes from the halving cycle, or do you think there's other factors that go into it?
Right. So I think the supply shock is definitely a big part of it. Last cycle could have been a coincidence, because that's when like inflation reached to 9%, and we had the quickest interest rate hike ever. So that could have been a coincidence.
Yeah.
Right. And now that we have 3 precedences, and it could be a self-reinforcing theme that just kind of plays out. So I think there are definitely multiple factors, right? But I think supply and demand, and a little bit of a coincidence in 22 might have kind of established the narrative.
Yeah, I think there was a lot.
Stone, right? Now it's carved in stone.
Yeah, I think there was a lot of liquidity injected very quickly in that cycle, which caused a kind of that hyper cycle, whereas 2017 liquidity was kind of introduced to the market a little bit slower in 2013. So I agree with you there. Yeah, I see it as the supply shock of the halving. I see it weirdly aligns with the presidential cycle, new president coming in. It very closely aligns with that. And I think liquidity as a big driver of the cycles as well.
Yeah, look, absolutely on the liquidity side, as you said. Yeah, this guy, guys, Satoshi, no joke, definitely a polymath. Figured out the societal, structural, scientific aspects of this before he unleashed it into the wild. So, yeah. Anything else, Chris, on your side as far as what you've been, talking to your compatriots in the space about the cycle, what they think will bring it? Obviously, I'm more focused on the Bitcoin side, but even as Bitcoiners, we all know that there's that specter of the alt season that will unleash or has in periods of past for different reasons. Will it stay meme coin only, or are the alt layer ones going to get out of their own way?
Yeah, no, I think kind of the meme coin craze has come to a bit of a lull. Kind of the December, January timeframe was where a lot of liquidity was flowing into that, and then towards the end of January, Trump launched his famous meme coin, and so I think kind of the meme coin cycle is starting to come to a little bit of a lull. And I think, with more liquidity in the economy, it flows to riskier assets, right? And altcoin are usually considered more riskier assets than Bitcoin. So I think as the quantitative easing starts happening, the dollar decreases, more liquidity gets injected into the system. I think a lot of that money will start to flow into the altcoins.
Cool. So it all goes back to Kevin's point about Scott Bessent being a wise trader, figuring out how to push yields down, then load the market up on 30-year and 10-year paper at 3.5%.
This is the biggest trade of anyone's life. This is the biggest trade in the universe. You have $10 trillion to play with this year, right? The P&L is going to be savings in the hundreds of billion dollars per year. And it's a 30-year legacy. This is the biggest trade anybody has ever seen.
And are they going to use those proceeds to buy Bitcoin? Sounds like Michael Saylor, like the MicroStrategy for the Treasury. But seriously, if they're going to buy 200 per year, how are they going to fund that?
Well, it's actually not a lot of money. Like, if
Yeah,
I
that's
think
true.
that translates to about um, like 100 or 200 billion dollars per year.
Yeah,
It's a
which
drop in
is
the bucket.
definitely not a lot of money when you look at the
It's
deficit.
it's it's a
When you
drop in
look
the
at
bucket.
those numbers, yeah.
Yeah,
Yeah.
yeah. It's like having a $370,000 mortgage and buying $1,000 car.
So it's a very small portion, but they will be funding that $200 billion purchase with long-term debt, and
Yeah, yeah,
that
but
seems like a pretty nice duration
yeah,
trade.
but U.S. is the only country or one of the only countries that can just print, right? Print paper and get Bitcoin. Right.
They are
Yeah.
one of the only ones. The
Everybody else will have to somehow earn U.S. dollars and then use that, right? They have to produce goods and services, earn U.S. dollars, and buy Bitcoin. So yeah, it's definitely a lot harder for Canadians than for the state of U.S. So yeah,
yeah, as a former Canadian employee, employee of a Canadian company, I got to get a little bit of a whiff of how things were, done there. And you're right, but there are a few things that hopefully will change for you up there, Kevin, on the fiscal front, including getting banks to start buying. Which I guess I just heard that National Bank of Canada bought a couple million. Was that one of those things where they traded it for another client, but they said that they bought it? I think 2 days ago. NBC.
yeah. I haven't got updated on that particular piece
Yeah.
of news.
I think it's clickbait.
Yeah, but like when I was that Bitcoin ETF portfolio manager, all the big banks were our market makers, so we know they're active on they're in on it. They may or may not disclose that holding, or they may or may not keep that on their balance sheet overnight, so that they don't have to disclose them. But they've been like looking this way for a very very long time.
Got it. Got it. And as we know, it's not easy to make money as a bank these days. So any new revenue will be coming in. Well, I think we're coming up on time. We want to sort of say that I thought this week was a big one for reasons that central banks shifted on both digital assets. I didn't mention it, but we'll share a link in the notes. That we had the Bank of England try to dust under the carpet the fact that they're 8 weeks behind on delivering gold because there's the demand is outstripping the ability to supply or deliver. And you also have overreach of the Bank of England by funding themselves, by funding the larger financial community because things are unstable. If there's one thing each of us go around the table here that you think people should look out for to guide their investment decision, given on your work, I'll start with you, Kevin. What do you think? What would you leave people with, either to read, to understand, or to look at, to become more familiar with your strategy or Bitcoin and digital assets?
That's a great question. I actually don't know. I think one of the like for me personally, like one of the most important things is to differentiate on every investment. Like, am I taking volatility risk? Or am I taking destruction of capital risk? So that you can size your bet accordingly, right? And then also, like, everybody has a different time horizon. So size your bets accordingly.
Got it. So
Yeah.
know yourself. Very philosophical of you,
Thank you.
as I know you are on approach. Chris, what about you? Besides suggesting people read your most recent report, what to talk to the normies, as we call them, in a loving manner, what would you tell your folks who aren't as familiar with digital assets that they should get off the dime and get interested?
Yeah, well, I guess to non-shamelessly plug my paper, I did just release an article on Ethereum and kind of looking at its competing L1s and supplemental L2. So I would say definitely take a look at that. I have been leaning towards Ethereum for the last couple of years just because of the technology that it employs. I am definitely pro Bitcoin and love Bitcoin as an investment, but I'm a technologist. I've been an engineer for over 10 years, so I like to look at the technology in the space as well. So Bitcoin's a great investment. Please buy it, but also take a look at some of Ethereum and some of its competitors. I think that's going to be a great long-term play from a technology perspective.
Got it.
And
Bill?
we are definitely not giving investment advice, but yeah, I'm actually going to work with Chris on part 2 of that paper. I'm excited about really developing a relative value view on the altcoins in particular. So within the Ethereum ecosystem, the smart contract platform being the sector, we're gonna come up with basically an index of those companies and the ones we like more than the others. And I think it will be a long only type of portfolio. But eventually I would like to think about ways to go long short. And, I also just wanted to reflect on what Kevin said. I like thinking about it as investments in things where you can have a permanent loss of capital versus what, a lot of times we talk about positive skew and, that asymmetric payoff where it seems like the volatility is good volatility, but I like putting it in those terms where volatility is okay with that upside, and I also didn't really think about it and contextualize the volatility with the Mag 7 either, which I think is important. Not that we're all Bitcoin and crypto bulls, even though we are. These are just compelling arguments for an old timer who took a long time to adopt this. Even the concept of this being an asset class that was like institutional in nature. So, yeah. But you can obviously read my research blog too at harmonicinsights.com or Substack and Smart Karma, but that's where my real views are, my short-term tactical views. But I'm excited about some of the relative value plays in crypto.
Got it. All right. Well, I think that's a wrap. Thanks, everybody, for joining us today. And please don't forget to hit like and subscribe for these to get future podcasts where we look at everything macro, top down, and bottom up across digital assets and the like, coming at you from the new Barbarians. And thanks again, Kevin, for joining us.
Thanks, Kevin.
Thank you for having me.
Thanks, Evan.